Ladies and gentlemen, American investors who are seeking a genuine edge in the financial markets. Over more than half a century of observing the stock market, I have witnessed every type of cycle, powerful bull markets that lasted for many years, deep market crashes that wiped out millions of investors, and remarkable recoveries that only prepared the stage for the next collapse. The market never truly rests. It constantly moves according to the law of supply and demand, where large operators, also known as the composite operator, direct the flow of price and trading volume to serve their own interests. From all these observations, I have drawn one core principle, simple yet powerful. The first rule of compounding is to never interrupt it unnecessarily. And the fastest way to interrupt compounding is to lose money. Large capital losses destroy both financial resources and the ability to recover. This may sound obvious, like advice not to touch a hot stove. Yet the harsh reality is that the market is filled with investors who have been severely burned, even completely wiped out, simply because they failed to follow this basic rule. They chased so-called guaranteed opportunities, used excessive leverage, or rushed into crowd-driven trends without realizing that when the tide goes out, those who are swimming naked will be exposed. From decades of real-world experience, I can state one enduring truth. The people who survive and truly succeed in the market are not the most intelligent. They are the ones who are better at avoiding stupidity. They do not attempt to defeat the market with complex maneuvers or by predicting every fluctuation. They focus on protecting capital, avoiding fatal mistakes, and allowing time and compounding to do the remaining work. Today, we will examine how to apply this survival rule in practice. We will revisit historical lessons from major crises, identify the common mistakes made by the crowd, and explore principles of capital preservation in the face of herd behavior and the powerful influence of the composite operator who constantly seeks to manipulate emotions for profit from undisciplined investors. In the market game, you do not need superior intelligence. You only need the discipline to avoid self-inflicted wounds. Once you achieve that, compounding, the true force of wealth creation will carry you farther than you imagine. Let me take you back to one of the harshest lessons the stock market ever taught a generation of American investors, the Great Depression of 1930. At that time, men who once held stable jobs were forced to sell apples on the streets. Families lost their homes. Assets were liquidated at distressed prices. A productive farm could be purchased for the price of an old automobile. This was not a story from a textbook. It was painful reality unfolding in real time. The central lesson from that period was clear: if you are excessively leveraged and the tide turns, you will be swept away with no escape. In contrast, those who maintained conservative positions, lived below their means, and refused to let greed push them into leverage were the ones who survived. Only a few decades later, history repeated itself in a different form. Soaring inflation eroded purchasing power. Stock prices declined sharply. Oil prices increased fourfold within a short period of time. Once again, many highly educated and experienced individuals lost their entire fortunes. The reason was simple. They borrowed too much. They believed in endless growth. They chased the dream of rapid wealth without recognizing that the market can change overnight. From these two major crises, I draw an essential conclusion that every American investor should remember: survival is not secured by intelligence or complex analysis. It is secured by prudence. Survivors avoided unnecessary debt. They ignored the latest hot tips from Wall Street. They refused to follow the crowd. As a result, compounding, the quiet yet powerful force, continued to operate year after year, decade after decade, transforming modest investments into substantial wealth. Now we must confront a difficult truth: not losing money is far more important than making money. The desire to win big, to triple one's capital in a short period, has destroyed more fortunes than poverty ever did. Consider the casinos in Las Vegas. The bright lights on the Strip are not funded by winners. They are funded by losers who believed they had a perfect system. The stock market is no different. It is simply larger, more sophisticated, and dressed in the language of professional investing. The composite operator, the true large-scale force controlling supply and demand, exploits moments of excessive confidence and crowd greed. They create artificial price advances, encourage investors to borrow and buy, and then allow sharp market corrections that force undisciplined participants to liquidate at the lowest prices. Therefore, the survival rule I consistently emphasize is this: protect capital first. When you avoid large losses caused by debt and blind confidence, compounding will do the rest. That is how ordinary investors become truly wealthy over time. One of the mistakes I once made and still remember clearly was buying what are known as cigar butt stocks. These were companies that looked extremely cheap on financial statements, like a discarded cigar with only one last puff remaining. I believed I was being clever by purchasing a bargain. In reality, cheap garbage is still garbage. The company was decaying from within. I earned a small gain at first, then quickly lost everything, including several valuable years that could have been invested in truly strong businesses. The unpleasant memory of that mistake stayed with me for many years. From this painful experience, I drew an important lesson that I want to share directly with you. The cost of avoiding stupidity is always far lower than the cost of correcting stupidity. If you truly want to protect capital and allow compounding to operate over the long term, you must actively eliminate the following obvious disasters. These are the exact mistakes that the composite operator consistently exploits in order to extract money from undisciplined crowds. First, never borrow money that you are not absolutely certain you can repay, regardless of whether the market is rising or falling. Leverage can make returns appear more attractive during favorable periods, but even a modest market correction can eliminate your capital. Second, do not purchase any stock or business that you do not genuinely understand. You must understand the business model, the competitive advantage, and the mechanism of profit generation. If you do not understand it, remain on the sidelines. It is that simple. Third, do not rely on hot tips from individuals who earn their income by selling advice. They are not concerned with whether your portfolio survives. They are concerned with commissions and advisory fees. Fourth, never assume that you are smarter than the market. The market represents the total force of supply and demand, including all known and unknown information. The composite operator operates from a position of strength. They generate enthusiasm, encourage investors to chase rising prices, and then allow the market to reverse after the crowd is fully committed. When you eliminate these four obvious errors, something remarkable happens. You do not need to become the greatest investor. You only need to survive. I never attempted to become wealthy quickly. I focused on a single objective: never go bankrupt. That small difference between trying to win big and committing to never lose big compounded over decades into substantial wealth without the need for any miracle. This is the true secret of the most successful American investors. They did not defeat the market through superior intelligence. They simply became exceptionally skilled at avoiding foolish mistakes. Once you accomplish that, compounding will perform the heavy work on your behalf. That is when the game gradually begins to shift in your favor. After eliminating the obvious foolish mistakes, we must confront another silent yet extremely dangerous enemy: envy. This is the most irrational vice in investing because it does not even provide satisfaction. Desire can feel exciting. Pride can create a brief sense of power. Envy is different. It is like drinking poison and waiting for someone else to die. I have seen many American investors work diligently, earn consistent returns, and live respectable lives. Yet they fall into persistent misery simply because of comparison. A neighbor drives a more expensive car. A former classmate buys a larger home. A colleague becomes wealthy slightly faster. Suddenly, what they already have feels insufficient. They begin to take irrational risks in order to catch up. At that moment, they step away from the path of survival we discussed earlier. Consider market bubbles to understand how this mechanism operates. Technology stocks in the 1990s, real estate in 2006, cryptocurrencies in 2021. Different years, yet the same underlying irrational behavior. The crowd becomes involved because they see others getting rich quickly, so they join. The composite operator understands this psychology very well. They push prices higher to create fear of missing out, then allow sharp corrections after investors have committed most of their capital. I clearly remember the dot-com bubble in the late 1990s. At that time, we appeared outdated because we did not participate. Friends boasted about internet stocks that multiplied several times within a single year. They were wealthy on paper. We were labeled conservative and old-fashioned. Yet only a few years later, most of those paper fortunes disappeared. Meanwhile, simple and unexciting investments continued to compound steadily over time. Therefore, the most practical and powerful advice I can offer today is this: there will always be someone who becomes wealthy faster than you. That fact changes nothing. Stop watching other people's scoreboards. Focus entirely on your own strategy. You do not need to win every race. You only need to avoid losing your position. The person you envy today may face bankruptcy tomorrow while you remain secure because of discipline. Once you free yourself from envy, investing becomes far simpler. There is no pressure to chase trends. There is no fear of missing out. There is only the calm patience that allows compounding to perform its work. That is when you truly control the process instead of allowing the emotions of others to dictate your portfolio decisions. Remember this, the market does not reward the fastest participant. It rewards the one who endures the longest. And the one who endures the longest is the one who has the discipline to play their own game. After freeing yourself from envy and deciding to play your own game, the next critical step is learning how to select the right business for long-term partnership. This is where many American investors make a common mistake. They underestimate the power of compounding from truly great businesses simply because those businesses appear too expensive at the beginning. I made this mistake myself. For a long time, we avoided investing in Coca-Cola because the share price seemed high. We believed we were being prudent by waiting for a lower entry price. That was a serious error, not because we lost money, but because we underestimated the long-term value that an exceptional business can generate over decades. Let me state this as clearly as possible. Paying a slightly higher price for a quality business is far safer than buying a cheap piece of garbage. Garbage eventually goes to zero. A quality business continues to compound, building substantial wealth over time. The real mistake is not paying 20% more for Coca-Cola. The real mistake is never buying it because you are too busy hunting for bargains among inferior companies. The key lesson to remember is this: substantial wealth is not created by clever buying or selling. It is created by patient holding. Time is the enemy of poor businesses, but it is the greatest ally of excellent businesses. The composite operator understands how to create the appearance of cheap stocks to attract impatient investors. Prices are pushed lower to make opportunities look attractive, and then time reveals the truth. Quality determines the outcome. The American stock market is fair in its own way. It punishes impatience and blind bargain hunting. It penalizes those who believe price is more important than quality. In contrast, it rewards investors who select businesses with durable competitive advantages, management teams that think like owners, and the ability to generate growing profits over many decades. Once you choose the right quality business and exercise patience, compounding performs the remaining work. There is no need to predict market movements. There is no need for constant trading. Own excellent assets and allow time to apply its force. That is how a sound decision evolves into substantial wealth without requiring superior intelligence. Next, we will examine how to recognize your own limitations so that you do not fall into the traps the market consistently sets for investors. After learning how to select quality businesses and allowing time to work on your behalf, we must confront an even more important lesson: recognizing your true limitations. Most American investors do not lose money because the market is impossible to predict. They lose money because of overconfidence. They believe they know more than they actually do, and then they begin to say the most dangerous phrases in investing. This time is different, or the old rules no longer apply. Each time those words are spoken, the composite operator smiles because they understand precisely when the crowd is ready to be trapped. Our circle of competence is far smaller than most people imagine. After reading a few online articles, listening to a television commentator, or watching several analytical videos, many individuals believe they fully understand the oil industry, advanced technology, or even global currency markets. The reality is the opposite. Genuine expertise requires years of observing supply and demand, studying financial statements, and understanding how a business generates sustainable profits. Everything outside that circle is a danger zone. Let me provide a clear example from personal experience: the airline industry. We avoided this sector for decades because it possessed too many structural disadvantages. It required enormous capital investment. It operated within harsh business cycles. It faced complex labor union negotiations. Fuel costs were volatile. All of these factors worked against investors. Later, when certain surface conditions appeared to improve, we assumed the industry had fundamentally changed and decided to invest. That was a mistake. The business did not change. We simply relaxed our discipline. Fortunately, we did not commit excessive capital, so the loss was limited, and we exited quickly. The lesson is powerful. Acknowledging what you do not know is one of the greatest advantages in the stock market. You do not need to swing at every opportunity. You only need to act within your area of understanding. When encountering a sector or a stock you do not truly comprehend, the intelligent response is to remain silent and inactive. That simple discipline preserves more capital than thousands of so-called intelligent opinions from experts or friends. The composite operator consistently exploits investor arrogance. They create compelling narratives, push prices higher to encourage the belief that I understand this, and then allow sharp corrections after the crowd has fully committed capital. In contrast, humble investors who can say, I do not know and I do not need to know, are the ones who endure the longest. Once you understand your circle of competence and the power of humility, you are ready for the next essential mindset, thinking like a true owner rather than an employee. That is the key to allowing compounding to operate at maximum strength. When you clearly understand your circle of competence and have the humility to admit what you do not know, the next step determines whether your portfolio will endure or merely survive temporarily. That step is the difference between the employee mindset and the owner mindset. The average investor thinks like an employee. They optimize for the next quarter. They protect their position. They protect their ego. They wait for short-term praise. A true owner thinks 20 years ahead. They do not care whether the portfolio appears attractive in a quarterly report. They care whether the business remains strong, continues to generate sustainable profits, and maintains a durable competitive advantage decades into the future. Allow me to illustrate with a classic investment. In 1972, we acquired See's Candies. At the time, many analysts on Wall Street argued that we paid too high a price. If we had thought like career managers, we might have worried about press opinions and short-term metrics and possibly avoided the transaction. Instead, we thought like owners. We recognized a powerful brand, deeply loyal customers, and a simple yet highly durable business model. More than half a century later, that original investment became one of the most successful returns in modern investment history, entirely because compounding operated continuously. Now consider the newspaper industry in the middle of the 20th century. At that time, newspapers enjoyed high profit margins, near local monopolies, and dominant advertising platforms. An owner mindset would have asked, the internet is approaching. How must we adapt to protect our economic moat? Instead, many leaders behaved like career managers. They focused on riding the wave until stock options vested and retirement packages were secured. The result was industry decline. Shareholders were left with significant losses, and many once powerful businesses disappeared or weakened dramatically. Therefore, here is a practical guideline to apply immediately. When evaluating any business, ask one question. Is management thinking like owners or like career managers? If they are willing to sacrifice today to strengthen tomorrow, that is a positive signal. If they sacrifice tomorrow merely to improve today's appearance in reports and media coverage, maintain distance. When you align your capital with leaders who think like owners, patience becomes your greatest asset. Compounding is no longer a vague hope. It becomes an inevitable outcome. That is when the market begins to reward you, not because you are more intelligent than others, but because you are thinking correctly. Next, we will examine the 3 greatest risks that can destroy everything we have built so far. Avoiding them significantly shifts the balance of survival in your favor. After building a solid owner mindset, we must protect that foundation by strictly avoiding the 3 greatest threats that can destroy all prior effort. These are not ordinary market risks. They are self-inflicted errors, the very weaknesses that the composite operator exploits to extract money from undisciplined crowds. If you avoid these 3 dangers, you significantly tilt the balance of survival in your favor. The first and most dangerous threat is debt. Debt is like a loaded firearm. It can destroy your portfolio even when you believe you are being careful. We witnessed this during the Great Depression during the 1970s, and again in 2008. The survivors were not the most intelligent. They were the ones who simply refused to borrow amounts they could not confidently repay. Leverage can make returns appear attractive during prosperous periods, but even a mild recession can eliminate your capital and prevent compounding from ever resuming. The second threat is drama. This includes unnecessary complexity, emotional instability, and internal conflict. I have seen entire companies destroyed because leadership teams could not cooperate. I have also seen investors damage their own portfolios because they could not resist the excitement of rapid wealth schemes. Sound business and investing should be boring. If you crave excitement, go to a racetrack or play video games. In the stock market, boredom is a competitive advantage. The third threat is foolish or dishonest people. Avoid them completely. A poor partner or an unethical management team can damage you faster than an economic downturn. Consider the Salomon Brothers scandal in 1991. A firm that was once powerful nearly collapsed because of reckless and dishonest behavior by a trader. The lesson is clear. It is better to partner with a mediocre business led by honest and competent managers than to invest in an outstanding business controlled by a dishonest individual. Avoiding these three dangers does not make you more intelligent than others. It simply means you will suffer fewer self-inflicted wounds. Survival comes first. Wealth follows. Once debt drama and foolish partners are removed, you have a stable base for building enduring partnerships and maintaining long-term discipline. That is when compounding can operate at maximum strength. In the next section, we will examine how to apply these principles in practice. After removing the three greatest threats, debt, drama, and foolish partners, we enter the phase of practical application. Long-term discipline and strong partnerships now determine whether survival can evolve into genuine prosperity. A successful partnership is not built on mutual brilliance. It rests on stronger foundations, strict discipline, exceptional patience, absolute trust, complementary skills, and most importantly, the willingness to appear foolish for extended periods. When others chase trends and boast about paper profits, you and your partner must remain calm and even tolerate being labeled outdated. The dot-com bubble provides a clear example. During that period, nearly everyone boasted about soaring internet stocks. We chose inactivity. For approximately 2 consecutive years, we appeared mistaken. Friends and colleagues criticized our lack of excitement. Yet when the bubble collapsed, paper fortunes disappeared within months, while simple and conservative investments continued compounding steadily. That is the power of refusing to follow the crowd. We also learned that detailed economic forecasting is unnecessary. Predicting oil prices, future interest rates, or short-term economic conditions often produces more errors than accuracy. Instead, we invested in what required no prediction businesses with strong fundamentals, owner-oriented management, and durable competitive advantages. When you own such businesses, time performs the remaining work. No one avoids mistakes entirely. We invested in the airline industry after believing structural conditions had improved. We were wrong. We also failed to invest in Microsoft, despite understanding the leadership of Bill Gates and recognizing the company's value. These errors may have cost billions in potential gains. The key is not eliminating all mistakes. The key is avoiding fatal mistakes, those that destroy your ability to recover. A strong partnership does not eliminate errors. It ensures that errors do not sink the vessel. Absolute trust prevents wasted energy on internal politics or suspicion. Complementary skills refine decision-making. One partner may excel at identifying undervalued assets. The other may excel at recognizing durable competitive advantages and business quality. Together, this combination creates strength greater than any individual effort. For American investors building their investment careers, seek relationships grounded in discipline, patience, and trust. Do not search for genius. Seek someone you can rely upon when markets are at their worst. With that foundation, long-term discipline transforms sound decisions into extraordinary outcomes, not through perfect execution, but through fewer catastrophic errors than the broader market. Now we arrive at the conclusion where all these principles are distilled into the simplest and most powerful message that has guided my nearly century-long observation of the market. We have traveled a long path together from the core principle of compounding through harsh lessons from major crises, identifying foolish mistakes, eliminating envy, selecting quality businesses, building a circle of competence, adopting the owner mindset, avoiding 3 major threats, and applying long-term discipline through strong partnerships. Now let us condense everything into one final message, the message I have followed through nearly a century of observing the American stock market. I never created a grand plan to become a billionaire. There was no secret formula, no complex strategy, no brilliant forecasting. Wealth accumulated because I avoided enough foolish mistakes and allowed compounding to perform the heavy work. That is all. Observe the average investor on Wall Street or across the United States. They chase popular stocks. They enter when enthusiasm is high. They buy at elevated prices and then panic sell at lower prices during market corrections. The outcome is predictable. Wealth erodes gradually. The power of compounding is interrupted. In contrast, those who truly succeed live below their means, invest only in what they clearly understand, and remain inactive when no clear opportunity exists. They do not boast. They do not seek excitement. Yet over time, they become wealthy almost naturally. One surprising truth that many resist accepting is this: preserving wealth is far easier than creating wealth. Once you possess a meaningful capital base, your primary task is no longer doubling your money each year. Your primary task is avoiding catastrophe. Avoid major losses. Avoid errors that permanently damage your portfolio. Compounding will handle the remainder. After nearly a century of witnessing empires collapse, bubbles inflate and burst, and once dominant industries disappear, I can state with confidence that the secret to not losing money is not complicated. It is discipline, not intelligence, not genius. Discipline. Rule 1, do not lose. Rule 2, do not forget Rule 1. Everything else, technical analysis, economic forecasts, and popular advice, is commentary. Therefore, this is my final call to action for you American investors. Building your financial future, build your life and your portfolio on survival, not on luck. Forget superior intelligence. Forget clever tactics. Forget shortcuts. Simply do not lose. That single principle is more valuable than all the investment books in the world. The market is unforgiving yet fair in its own way. It does not care about hope, excuses, or academic credentials. It only determines whether you survive long enough for compounding to operate. Ask yourself each day, are you building on survival or on luck? Luck eventually disappears. Survival does not. Thank you for accompanying me through this lecture. Apply these principles consistently. The long race does not belong to the fastest runner. It belongs to the one who endures the longest, and endurance belongs to those who avoid self-inflicted wounds. I wish you success and peace on your investment journey.